Every day, you make economic decisions. Should you buy the name brand cereal or the store brand? Should you fill up the gas tank now or wait? And behind the scenes, companies are making their own calculations. How many workers to hire? How many units to produce? What price to charge? These decisions all connect through three powerful ideas: utility, elasticity, and cost. Today, we are going to trace that connection from the consumer's first sip of coffee to the factory floor, using real case studies every step of the way. Let us start with the consumer. Utility is the satisfaction you get from consuming a good or service. Economists used to talk about utils, theoretical units of happiness. But the real insight is marginal utility, the extra satisfaction from consuming one more unit. Here is a case study you have lived. Imagine walking into a coffee shop on a cold morning. That first sip of coffee is incredible, high marginal utility. The second cup is still good, but less satisfying. By the fourth cup, you are jittery, and the marginal utility is near zero, maybe even negative. That is diminishing marginal utility in action. And it explains why the first slice of pizza at a party is worth far more to you than the sixth. Now, goods do not exist in isolation. When the price of one good changes, it affects demand for related goods. Substitute goods replace each other. If the price of coffee jumps, tea sales go up. Think about Coca-Cola and Pepsi. When one raises its price, the other gains customers. The cross-price elasticity between Coke and Pepsi is positive, meaning they are strong substitutes. Complementary goods are used together. When the price of printers drops, demand for ink cartridges rises. When gasoline prices spike, demand for large SUVs falls. These have negative cross-price elasticity. And independent goods, like paper and laundry detergent, barely affect each other at all. Understanding these relationships helps businesses predict how a price change will ripple through the market. Price elasticity of demand, PED, measures how much quantity demanded changes when price changes. The formula is the percentage change in quantity divided by the percentage change in price. If PED is greater than 1, demand is elastic. Consumers respond strongly to price changes. If PED is less than 1, demand is inelastic. Consumers barely budge. If it equals 1, it is unit elastic. The midpoint method is the standard way to calculate these percentage changes. You take the change divided by the average of the starting and ending values. This gives you the same elasticity whether the price rises or falls, which makes your comparisons consistent. Let us look at real elasticity numbers. Gasoline is a textbook inelastic good. When prices spiked in the 2000s, consumption barely dropped in the short run because people still needed to drive to work. Studies estimate short-run PED for gasoline at around negative 0.1 to negative 0.3. That means a 10% price increase only reduces quantity demanded by 1 to 3%. Cigarettes are even more inelastic because of addiction. PED around negative 0.4. Governments tax them heavily, knowing demand will not collapse. On the other end, luxury goods like vacation air travel are elastic, PED around negative 1.6. A 10% price hike cuts demand by 16%. And here is the twist. Some luxury goods act as Veblen goods. For a Lady Dior handbag, higher prices can actually increase demand because the price itself signals status. Elasticity is not always straightforward. Cross-price elasticity extends the same logic across goods. The formula is the percentage change in quantity demanded of good X divided by the percentage change in price of good Y. A positive value means the goods are substitutes. When Starbucks raises coffee prices, Dunkin' Donuts sees more customers. A negative value means they are complements. When Sony raises PlayStation prices, demand for game controllers drops too. The magnitude matters too. Close substitutes like Coke and Pepsi have high cross-price elasticity. Weak substitutes like coffee and energy drinks have lower values. Businesses use this data constantly. A supermarket chain might analyze cross-price elasticity to decide whether to put peanut butter on sale to boost jelly sales. Now we cross from the consumer side to the producer side. Every firm faces two kinds of costs. Fixed costs do not change with output: rent, insurance, equipment leases. Variable costs do change: raw materials, hourly labor, electricity. The source gives us a concrete table for a company making Lazibots per day. Fixed costs stay at $100 regardless of output. Variable costs climb from $200 at 2 units to over $1,000 at 9 units. Total cost is the sum. Average total cost starts at $150 per unit, then falls to $121 as fixed costs spread out. That is economies of scale. But eventually it ticks back up to $124. Marginal cost tells a similar story. It stays at $100 for the first few units, then jumps to $117, and finally to $150. That jump signals that producing the 9th unit is significantly more expensive than the 8th. Why does marginal cost eventually rise? The answer is diminishing marginal product. The production function links inputs to outputs. Marginal product is the extra output from one more unit of input, one more worker, one more machine hour. At first, adding workers to a factory with fixed machinery raises output nicely. But eventually, workers start getting in each other's way. The marginal product falls. Here is a farming case study. On a fixed 10-acre wheat field, the first worker might harvest 19 bushels. The second adds 17. The third adds only 14. The land is the same size, but each worker has less room to work efficiently. In a dairy barn, overcrowding cows past capacity actually reduces milk output per cow. The marginal product can even turn negative. This is why managers watch their marginal numbers closely. Pushing past the point of diminishing returns destroys profitability. Profit is total revenue minus total cost. But the key to maximizing profit is thinking at the margin. Marginal revenue is the revenue from selling one more unit. Marginal cost is the cost of producing that unit. Marginal profit is marginal revenue minus marginal cost. The decision rule is beautifully simple. If marginal revenue exceeds marginal cost, produce more. Each additional unit adds to profit. If marginal revenue is less than marginal cost, produce less. That unit is losing you money. The sweet spot is where marginal revenue equals marginal cost. Let us apply this to the Lazibot table. Suppose the market price is $120 per unit. So marginal revenue is $120. At 8 units, marginal cost is $117. Produce the 9th unit, profit goes up. But at 9 units, marginal cost jumps to $150, which is above $120. Stop at 8 units. That is profit maximization in action, using the firm's own cost data. Finally, we look at the supply side. Price elasticity of supply measures how much quantity supplied changes when price changes. The formula mirrors demand elasticity. Percentage change in quantity supplied divided by percentage change in price. Here is where timing matters enormously. For cars and apartments, supply is inelastic in the short run. You cannot build a factory or an apartment complex overnight. But in the long run, supply becomes elastic as new capacity comes online. Aquarium fish tell the opposite story. When a species becomes popular, breeders can quickly increase supply in the short run. But if the fish becomes endangered, long-run supply becomes inelastic because you cannot breed more of a protected species. The key insight: elasticity is not a fixed property of a good. It depends on the time horizon, the availability of inputs, and the flexibility of production. The same good can be elastic in one context and inelastic in another. Let us pull it all together. First, utility and marginal utility explain why the first unit of anything is worth more than the last, and that shapes the demand curve. Second, elasticity measures how strongly consumers and producers respond to price changes, with real-world values ranging from inelastic gasoline to elastic luxury travel. Third, cross-price elasticity reveals whether goods are substitutes or complements, helping businesses anticipate market ripple effects. On the production side, fixed and variable costs combine into the cost structure that every firm manages. Diminishing marginal product explains why costs eventually rise. And the profit maximizing rule, produce where marginal revenue equals marginal cost, gives managers a clear decision framework. Finally, supply elasticity reminds us that responsiveness depends on time. What looks inelastic today may become elastic tomorrow. These concepts are not just textbook definitions. They are the tools that consumers, businesses, and policymakers use every day. From the utility of that first morning coffee to the factory floor decisions about how many Lazibots to build, microeconomics gives us a consistent framework for understanding choice. Utility drives demand. Elasticity measures response. Costs constrain supply, and marginal analysis finds the sweet spot. These ideas connect every decision in the economy, yours, mine, and every business in between. Thanks for watching.